Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 288th VideoCast podcast for the week ending April 24th, 2025, live from the Big Island, Hawaii. Aloha, everyone. I've got my authentic Tory Richards shirts that I got over at the King Shops, and excited to bring a lot to you. But as always, family first, then we'll get right down to business. There's Annabelle paddleboarding. We're at Mauna, Lani, which is just incredible. That's the private beach club there. She's able to paddleboard, snorkel. The girls loved it. This was an incredible luau that we went to in downtown Kona at one of the Marriotts. It's the most authentic one. It was beyond expectations. How this thing doesn't have 5-star reviews all across the board is beyond me. They pulled this pig that they cooked in the ground, out of the ground, and like chopped it up. Absolutely incredible. Too much to cover. As you can see, I don't have the proper height to be a hula dancer, so we'll just stick to stocks. This was at this was at Ulu at the Four Seasons. Caitlin and I went out for date night. We met the most incredible couple, Jerry and Kathleen Grundhofer. And I know Jerry, I didn't even realize when I was talking to him, I'm so embarrassed now. This guy is an absolute legend. He was the chairman and CEO of U.S. Bancorp when Warren Buffett owned U.S. Bancorp, and spoke about how incredible Jerry was in all of his annual letters. And we were talking about his roll-ups. He's just one of the greatest banking CEOs in the history of the United States. And like all great men, there is even more spectacular woman behind them. We just had so much fun meeting with them, and so much so that we missed our dinner reservation because we had to go pick up the girls because they were swimming with the local swim club, which we're going to talk about in just a second. But Jerry and Kathleen, great to spend time with you at Ulu. This is with the girls downtown. Okay, this is the swim club that the girls swam with, the Waikoloa Swim Club. Absolutely incredible. They became honorary team members for the week and enjoyed training with their team and making new swim friends on the Big Island. So that's super, especially because Annabelle and Mimi both have meets and games this weekend. Moving along, that was the helicopter tour. That's a panoramic view. That's why that picture looks strange. That's a normal view with Caitlin, the girls, and I. We landed the helicopter at this special waterfall that you can only get to via helicopter. You could see it's absolutely incredible. That was Blue Hawaiian Tours. That's me and Annabelle in the front, which was super cool. That's a little view for you. That's the girls in the back, Caitlin and Mimi. This is a volcano that was active twice this week. Of course, the day we went, it wasn't active, but you know what? I'll take no wind in a helicopter to an active volcano any day of the week. So that was that. More pictures. I could tell you, I mean, I saw the ladies in the audience were just staring at this guy nonstop the entire night. It was kind of weird, but nonetheless, here's some pictures from that, and you should definitely check it out when you're in town. This was played Mauna, Lani, South and North all week. I want to thank my friends Robert and Desiree Smock. We stayed at their house right on the third hole of Mauna Lani South. If you're ever going to Hawaii, you should rent their house. It's absolutely perfect. 3 bedrooms. These are the views from your backyard. Look at that sunset. You can walk to the beach club. They have golf carts. You can go to the resort. You can go to Canoe House, which is seriously one of the best restaurants. I'm going to put this link right in the show notes. So go to youtube.com, click on Hedge Fund Tips. Go to Hedge Fund Tips channel. So in the search bar for YouTube, just go to Hedge Fund Tips, and then under episode 288, right under the play button, you'll see show notes. I'll put the link. If you're coming to Hawaii, you can rent their house on Airbnb. Absolutely incredible. So that's that. And then a couple more things just wanted to cover real quick. And then we'll get down to business here. Okay. So that's the South Course. That was my favorite. A lot of people like the North Course, by the way, which is really cool. They've got these bucket greens. That's more from there. That's the South Course picture. And you just play it. I mean, it's unbelievable, all the water holes on the South Course. But then again, I'm a tourist. This is the bucket hole on the North Course, par 3. Really cool. That's all lava rock. That's the girls at Napua, which is a great restaurant in the private beach club when you stay at Robert and Desiree's house. That is Canoe House, which is also in this development. I think that's the best restaurant I've been to in 5 years. And the Wagyu was incredible. There are 2 types of Wagyu, 2 types of fatty tuna. This beet salad was incredible. Their bread, they're famous for their bread. It's pull apart bread, the corn. You got to check it out. And obviously the views don't suck. So there you go. That was that. That's the backyard from the house. This is my new friend, Sheriff. He's a member up in Olympic. And can't wait to play up there. We had a great time on the South Course. He's a CIO for a big family office. And actually worked for Citadel for a while. So this guy is a serious hitter. And I think that's that. So you got the link again in the YouTube video. Want to thank Liz, Clayman, Brooke, Hallisgak, and Jake Mack for having me on Fox Business today, live from Hawaii, to talk about my favorite things, the market, and a couple of picks, Boeing and PayPal. We're going to listen in here.
All right, let's get right to the floor show and bring in our traders to talk about all of this and the green on the screen. Joining me now, trader Keith Fitzgerald and Great Hill Capital's Tom Hayes. Tom, look, regardless of a tarnished brand and the long-term effects of that, these back-to-back gains sure feel good, right? I mean, you've got the VIX falling again, back below at least earlier 28 at the moment. Yep, it's almost below 27 right now. Remember, it hit a high of 60 earlier this month. Bond yields are dropping, at least on the long end. What's not to love, Tom?
What's not to love? This is an example of the VIX crush and one more example of getting paid for being greedy when others were fearful. You had a couple other things out there today, Liz. First and foremost, you had Governor Hammack from Cleveland talking about maybe alluding to a cut in June if the labor market deteriorates. That's confirming what Waller said. The market really likes the idea of a June Fed cut. And it's very interesting about this correction, Liz, because this was the first time that I've seen in my long career that professionals were actually more scared. They were abject fear 2 weeks ago, and retail investors were actually net buyers. And retail investors, believe it or not, have been the ones that are on the right side of the trade since COVID. They've been buying weakness, and they've been right, and this time will be no different.
Well, yeah, the retail investor is buying. The hedgies had been liquidating. They didn't want to be caught flat-footed, or maybe some of them were. Keith Fitzgerald, you too have had a long Wall Street career. What do you learn from this? Because 3 days in a row is really lovely, but we know that bottoming out processes take a long time.
Well, they do, and that's really the lesson here. I mean, it's 45 plus years for me. I've been doing this, and fortunately, we've gotten a lot more right than we've gotten wrong. But, you know, the lesson I take away from this is bottoming is a process. It's not a switch. There's no all clear bell when it rings. So you want to constantly play, to Tom's point, you know, when others are fearful, you want to be greedy. And time again, the best companies move ahead, which is why you're seeing traders trying to get ahead of it today.
Yeah, and, you know, you do want to focus, Tom, on things you actually can control. And what do you feel you can control when you certainly can't control, as we put it, the he said, she as in XI, Xi Jinping of China, that we really aren't sure exactly what the true story is at the moment?
Yeah, Liz, well, I learned early in my career that good things happen to people who buy great companies when they're marked down on sale. And what you saw 2 weeks ago was one of the sales of a lifetime. And people were comparing it to the great financial crisis. They were comparing it to the tech wreck. And the fact of the matter is, those were years and years of excess buildup. This was started with a tweet. It could end with a tweet. We saw tweets today about positive talks with South Korea, positive talks with India. So we want to buy high quality businesses marked down, and there's still quite a few of them on sale right now.
You know, the econo data is rear view mirror looking, but we did just get durable goods, Keith, and the durable goods orders for last month skyrocketed well beyond what was expected. A lot of that was sort of front loading, whether it was companies who were putting in a ton of orders ahead of what they perceived would be the tariffs that President Trump had threatened. So you're looking at something like that. They surged 9.2% in March, well above the 2.0 forecast. So what do you suspect is happening right now, and how do you not get caught sort of too deep in the water with certain companies that may shut down their inventory buildup?
That's a very interesting question. We learned a very powerful lesson out of COVID. We used to have just-in-time deliveries, but what you're seeing, this big surge in my takeaway, is just in case. So they're moving ahead. They're doing what they should be. And the companies that have margin power, protection power, customers that actually like what they produce are going to come out of this just fine. It's the guys that are ordering, the extra window cleaning solutions that you worry about, because maybe they're doing it, they don't have credit. Maybe they don't have the right cash flow. They're stockpiling something. That's the wrong move here. If you're doing it because of customers, then that's the stuff I'm going to be all over.
Yeah. Okay. Let's talk customers. Tom, you like PayPal. This is interesting. The CEO, Alex Chriss, was on stage right here at the Semaphore conference earlier today. I listened very closely to what he said. He's got 400 million customers. And what's important, I think, here is the fact that he said a lot of these customers are small businesses. And here's specifically what he said. He said, we are worried about rising costs that small business will face under the new Trump tariffs. So what do you see for the future of PayPal, which, sure, is up 3% today, but it has gotten hammered this month?
Yeah, this is still down 80% since the COVID highs. We love this business. Record free cash flow, record revenues, margins increasing. As you said, 425 million customers globally. When you take an Uber, Liz, that's PayPal. That's Braintree working in the background that they own. Venmo has become the Kleenex of peer-to-peer payments. Alex Chriss ran small business at Intuit. That was a 35-bagger stock while he was the CEO. We know he's going to turn this around. They'll generate $7.5 billion of free cash flow this year alone, and they're going to buy back 20% of the company over the next 2 to 3 years. Your slice of the pie is going to get bigger and bigger with no new investment. We think this is a phenomenal opportunity. Their fast lane checkout is increasing conversion for small businesses. They need it. PayPal's got it. Alex Chriss is a winner. You want to bet on him for sure.
Yeah, you're also betting on Boeing, which is actually up about 2%, even as Donald Trump says Boeing should default China over return planes. China's carriers have returned, I think around 2 planes, and more are coming back. They're not taking hold of them. But Keith, let's finish with you. What are you buying right now? I mean, I saw one of your favorites, Palantir, back above 100, earlier up 101. So that's interesting.
Well, I go, one of the other key lessons I learned during my career, Liz, is you go where Wall Street is dumping hardest and fastest. And so to me, it's all the big names we talked about. It's Palantir, it's NVIDIA, it's Tesla. Those companies have been punished in recent weeks, I think unfairly, yet every single one of those businesses is continuing to power forward, I think is worth considerably more in the future. Tesla in particular, 3 to 5x by the end of the decade.
Oh, man. Palantir's at 106 and change right now.
Yeah.
That is one interesting moving target.
It is. And it's a great company to latch on to because it's doing all the right things at the right time that still doesn't have any viable competition. And if you look at customers, they're running to it, not away from it.
Gotcha. Yeah, we see that now. Hey, it's great to have you both. Keith, Tom, we'll see you again soon. Thank you.
And we're back. Now let's go to some of these incredible indicators that we look at every week and get through some of the data. First and foremost, want to take a look at the put call coming down. That's what I referenced. Also, the VIX crush, when it goes above 50 and drops below, you tend to get rallies. You're starting to see a lot of breadth. The PMO by all, we cover a lot. PMO by SPX. We don't care about PMOs. It's just indicative of something that's turning in the market. It's just like the 50-day, 200-day crosses that people think make a big difference. They don't. One that we do spend a lot of time on is option skew. So the smart money buying catastrophic insurance has withered to nothing. It was very, very elevated beforehand. And you can see here the NASI summation and the McClellan-NICE are turning up, as well as these two as well. So everything is starting to look healthier again now that the administration is backing off. We're going to cover that. But if you feel like you missed everything, wake up and smell the roses, because there are still, as I shared with Liz, so many amazing companies that are still on sale. And I'm not pointing anything out, but this is just the Dow to give you an idea. Like some of these businesses that have been marked down, we don't own any of these. United Health, Chevron, Amgen, Merck, Cisco, et cetera, et cetera. So yeah, companies are starting to rebound a little bit. Nike, we've talked a lot about. And some of the defensives are starting to get weaker, like the Coca-Colas, the Pepsis, et cetera. So people are coming in from the thaw and jumping back into the market. We even saw some tech, which we discussed a couple of weeks ago. We said, I think Mag 7 could trade back to the top of the range, but probably not more this year. I think that is beginning right now. You're seeing some Meta, some Google, etc. Starbucks is still marked down. There's a lot of amazing stuff to do here, and we're going to talk about a bunch more on this call. Intel unveils turnaround plan, seeking to go back to his engineering roots with Lip, Boo, Tan. You know, I was sharing actually with Jerry last night. I'm always talking stocks. And I said, look, you know, the beauty of NVIDIA is they're great at designing GPUs. The bad news is that their business model depends on the kindness of strangers, and so do all the chip designers, and that stranger happens to be Taiwan Semiconductor. Now, Taiwan Semiconductor said, hey, we're going to put $500 billion in the U.S. Well, good luck. You know, we'll talk to you in 5 years after you get your zoning and you break ground and you hire all the people, et cetera, et cetera, et cetera. Intel is at the 5-yard line and ready to go. They fired Gelsinger at the exact wrong time. Lip Bhutan's going to take it from the 5-yard line over to the touchdown. NVIDIA is currently testing chips, etc. They're cutting 20% of the workforce. They're getting lean and mean, and they're going to go back to designing absolutely incredible products and manufacturing products for not only the NVIDIAs of the world. And it's funny, I've talked to experts that know Intel well, and they said the demand for GPUs is going to be so unlimited that it's not only going to be NVIDIA, assuming NVIDIA can get theirs produced, and the bottleneck for doing that, they've got to go through Intel or TSMC, and the reason their growth rate has declined, is because Taiwan Semiconductor can only give them an extra $4 billion a quarter. So unless they find new production centers like Intel, their growth rate is going to continue to decline because the base keeps getting bigger, and they're only allocated $4 billion of growth per quarter. So that's where Intel comes in, and I'm so excited to listen to the earnings call and Lip Bhutan's plan on the way home on the airplane, and that will be key. The other thing that I spoke to about with Liz was the odds of a June cut going up. As you can see here, it's around 63, 62%. So that's been vacillating from 70 to 50. That came from Waller talking about if jobs start to get lost, and that was confirmed by the Cleveland Fed governor today, and that's part of the reason that the market was up, as well as good news on South Korea talks, good news on India talks. Trump this week talking about taking down the China tariffs to get something done, and saying that there were talks happening this morning. The Chinese are like, we don't know anything about those talks, but okay. But it shows. And I think the key pivot point after the 90-day pause was meeting with the CEOs of Target, Walmart, Home Depot this morning, and getting a sense of like, hey man, you know, we'd love to manufacture sneakers in Mississippi, but at the end of the day, the economics just don't work if we're not paying the workers $2 an hour. So I think there's going to be a great compromise. And that great compromise, the media may portray it as Trump softening, but the joke is going to be on the media in that he's going to wind up with tens of billions of dollars, if not a couple $100 billion of revenue for the country that we wouldn't have otherwise, and do it in a sensible way such that we can get some clarity sooner so businesses can actually start to plan, because CapEx has ground to a halt, and businesses can start to feel confident and consumers can start to feel confident. So they'll probably get their first quarter of negative GDP, but my sense is they're getting worried about getting a second quarter, because if they get a second quarter of negative GDP, you got a technical recession, and that's going to cost a lot more than what they've saved on Doge or they've raised from their external revenue service, and it will all have been for absolute naught and a complete waste of everyone's time, and hurt a lot of retirees who probably sold in the hole 2 weeks ago, and certainly a lot of hedge funds that were selling when they should have been buying, or at the very least holding. Problem is they all run too much leverage, so they got their asses handed to them, and it's the same story every single time. So moving along, we've covered this for the last few weeks. I've handheld you through this tumultuous period. I said, hang on with your white knuckles, ladies and gentlemen, this too shall pass, and that's starting to happen. It doesn't mean we're not going back down to retest the lows. I'd say the probability is lower now, that's for sure, but this was the one. If you remember 3 weeks ago, I'm like, guys, look, I don't spend much time on technicals, but I shared this chart with a friend who was a little queasy there in the middle of it, and by the way, he was one of the more optimistic of my friends. Some of them were really, really nervous, and understandably so. And I said, look, if this holds, we're probably doing okay. And it immediately shot up the next day when Trump was like, buy now. I mean, we've got a stock promoter in chief. And then we went back and looked like we were going to retest, which we had told you here that was a possibility, looking back at 2011 as an analog. And we also talked about the 2018 analog. And then it did that, and now it's working up higher. And I think you're now going to start to see a little bit of fear of loss. That's not to say no damage has been done, ladies and gentlemen. We are seeing some good earnings. We're seeing some mixed earnings. We're seeing two-track guidances. If he continues to do, if the craziness continues, here's what our earnings will look like in a recession, which is guaranteed. Or if they cut bait and do something rational, we're actually cooking. And we will report good numbers, and we will continue to invest. And now that's starting to look like a possibility again with all of the news that we've shared. This is looking like recovery. So we did the 15-minute, the 60-minute. I swear I haven't pulled up 15-minute and 60-minute charts in probably since the lows in 2022, which was the last time I ever came on this and said, if you were going to put money to work with us, existing clients adding money, new clients getting started, now is the time. And the only other time that I've done that is 2 weeks ago at the lows in early April, and looking at all the opportunity, it really couldn't still be a better time. I mean, it's just phenomenal. Here's the daily, then the weekly. Weekly still you can see it, and then the monthly, barely a blip on the chart, but boy, did that feel pretty abrupt for a moment there. Reminder, Money Show, May 15th to 17th, I'll be down in Miami. I'll be in Dubai the week after, meeting with a good friend and client, and also the YPO out there for dinner. And then all my friends in Connecticut. I'll be back on the 10th and 11th on my way to New York, and we'll play up there. And then here's the quotes of the week. Peter Lynch, everyone has the brain power to make money in stocks, not everyone has the stomach. If you are susceptible to selling everything in a panic, you ought to avoid stocks and mutual funds altogether. That's from the legendary Peter Lynch. Charlie Munger, another mentor, in my view, by reading and assimilating. Same with Warren. It's the waiting that helps you as an investor, and a lot of people just can't stand to wait. It's amazing, people, texting me in the last couple of weeks, wow, it's green today, it feels so good. Like, we don't think ever in terms of days or weeks. We think in terms of months and years. So, Monday was a down day. I mean, honestly, the down days have been more exciting than the up days because there's something to do. We can buy stocks. The up days, it's just like, okay, we got all the stocks we're going to have. Here we go. We're going higher. We got enough in the hole. We're excited, and so on. And that's the way you learn to think about it. I think it's been a very rare occurrence in my career where I've bought stocks on a green day. There have been a couple of times, but we always buy when it's red. So games are won by players who focus on the playing field, not by those whose eyes are glued on the scoreboard. And so many get distracted by they spend their time looking at price on a daily basis. And when I get distracted by price because hedge funds are blowing up, pensions are forced sellers, margin people are getting margin clerk calls and liquidations, I just go to the free cash flow and I'm like, their cash flow keeps growing. I wonder why the price is going down so much in the short term. I better buy some more. And sure enough, that's always the right call. When the intrinsic value of the business goes up and the price goes down, if you play that arbitrage, you'll get rich over time. I mean, it's just that simple if you're patient and if you manage risk through not using a lot of leverage. And very few people can do that because, what is everyone asking me about? Everyone's asking me about all the stocks that are in the headlines. They have to ask me about Tesla. They have to ask me about NVIDIA. And the companies that are the best are the ones like Boeing that were completely forgotten. And you had another chance to buy it at $129 2 weeks ago. And we went on Varney and we went on all the shows and people were like, well, they're getting all their parts. Give me an effing break, ladies and gentlemen. At the end of the day, the biggest joke, I loved being on Varney in real time when that headline came across that the Chinese are refusing Boeing deliveries. I mean, the Chinese refusing Boeing deliveries is like a diabetic refusing insulin. They need our planes way more than we need their sales. Already, India's like, we'll take them. Can you paint over them and put India Airways or whatever they've got over there, Jet Airways, on the plane? And they're like, yeah, well, absolutely, we'll help you. Oh, and by the way, China, you want to lose your place in line? You can get back when this tariff thing is negotiated. You can get back at the end of the line and wait 20 years for your next plane. Oh, you got Comac. They delivered a whopping 13 planes last year. Let me clear my throat. That's not going to cut it. So China is making a mistake there, and not the first, won't be the last. But look, we've made our share of mistakes as well, and they sooner or later, the universal thing, whether you're in the United States or around the world, is politicians always make the right decision after exhausting every other possibility, and this time will be no different. All right, let's get to our data charts so I can get out of here and go to Copper Bar on the way to the airport and have a nice dinner. Everyone says that place. By the way, want to thank Terry H., you know who you are, and obviously Robert for putting together such an incredible, and Desiree for putting together such an incredible list of things to do. We literally packed every minute that we could, did all the snorkeling, did all the excursions, did everything, went to all the right restaurants, and it's very rare that the girls get a week off training, so we had to jump on it, and very grateful for making it super memorable. Okay. Let's talk about this. Some data. We love to do data. Burden ourselves with the facts. Share of Chinese exports to the U.S. is 14%, so it's relatively de minimis. It's even more de minimis for China these days. Another rare signal that better times could be coming. This is from Carson. S&P performance after 3 consecutive 1% gains. And you look a month out, 1.3. 6 months out, 9%, 12 months out, 14%. I love his anecdotes and data that he puts out. He does a really good job. Forward 12-month PE ratio at the sector level. Obviously, you can see that energy is still the cheapest. Financials, healthcare, there's a lot of opportunity there. Those are going to start to bounce aggressively. Friend sent over an amazing note on biotech. I think biotech's getting ready to rip despite Maha and Robert Kennedy Jr. I think that part of the solutions for the problem are going to come from innovative biotech companies, and they'll get that sorted, and better food and all the great things that they're talking about as well. Peter Lynch, the key to making money in stocks is not to get scared out of them. Here are flows into money market and cash ETFs. Always when it gets this high, you find yourself at or near a huge buying opportunity and a low. World ex-US equities versus the S&P 500. You can see here breaking this downtrend line. This is a theme that we came in at the beginning of the year, pounding the hell out of the table, get some international exposure. If not China, at least get some emerging markets, get some ex-US, get some Europe, and they've dramatically outperformed. I think ex-US is up 6.6% on the year, while the US has been down, albeit coming down less and less by the minute. China's broad budget deficit soars the first quarter. What that means in English is they are doing massive stimulus spending. They want to move, as we covered in recent podcasts, from 50 some odd percent consumption to 70% consumption within 10 years. US wants to move manufacturing back up to a higher percentage, and that's rebalance is where a deal is made. Then you look at affordability of vehicles down to 36.7%. By the way, everyone's sending me like, oh yeah, March, they shot the lights out. You've never seen so much car production, which is going to be amazing for Cooper Standard free cash flow. But then they expect April and May to fall off a cliff. April and May aren't going to fall off a cliff because, number one, there's still the urgency to get in ahead of time. And number two, they now have worked down the inventories and they're going to have to replenish the inventories on top of it. This is going to continue, as well as huge lobbying groups going to Washington. And it looks like Trump is going to find some middle ground for the suppliers and for the automakers, which will be a big deal. Margin debt expansion versus contraction indicator. We are nowhere near the extremes you see at or near tops. That's a good thing, not a bad thing. Dollar was another theme. Weak dollar coming into the year. Worst start to the year, basically on record. Everyone's starting to get bearish the dollar. You're seeing some covers. We're going to cover The Economist. Everyone bearish the dollar, which means we're probably due for a bounce. It will be a counter trend rally. Get ready for that. Here is emerging markets total return. Actually, it's even bigger. This is European, up 13% versus S&P down 10%. 11%, yeah, 10%. Okay. Japan's core inflation accelerates, complicating Bank of Japan's rate path. If they have to keep raising, carry trade continues to unwind, which is why we don't think the Mag 7 are going to get back above the top of the channel. But there's a long way between here and the top of the channel because they were hit the hardest, as was one of our key themes coming into the year. Go back and listen to our November and December podcasts. Price to fair value estimate by economic moat rating across size and style. All this says in English is small cap with wide moat, according to the Morningstar ratings, has the greatest discount to fair value, i.e. the most undervalued. If you don't have small cap exposure and you're skeptical because it hasn't worked yet, this would be a time to get on board, in our view. Again, all of this is opinion, not advice. Go to Hedge Fund Tips and read hedgefundtips.com and click on terms right there. Basically, it says it's for entertainment, don't do anything, talk to your financial advisor, etc., etc. Premium beverage, we are spending more on alcohol but drinking less. This is the whole theme of the Diageo narrative, which we've discussed in past podcasts. People's interest in escaping is never going to change. And if they're drinking less, they're going to want higher quality, higher premium. And that's where you benefit from doing the Diageos relative to the Constellations or other type of companies in the category. The best and worst days are usually close to each other. That's why if you're out of the market or you think you time, you screw up twice, because one, you sell in the hole, and then you think you're going to buy lower and it winds up moving against you, so you miss the gains back up, so you double lose. It's the way people blow up and never get ahead. Here are all the economies. Here are all the covers on The Economist, how a dollar crisis could unfold. So probably get a bounce in the dollar soon. The envy of the world, the U.S. So they're talking about the end of U.S. exceptionalism. We've covered in the past. We do think international is going to outperform because it runs in 10 to 15-year cycles. But that doesn't mean U.S. exceptionalism in the broad context will not continue. Never in the history of humankind has a greater company been created. And the reason is because, number one, we were blessed with resources. Number two, we were blessed with oceans on both sides for defense. But number three, and the most important, is we got the best ideas from every other country in the world, all converged on one great place called America. And with hard work, with a dream, with a risk-taking DNA for them to take that chance to come to a new country. And the only thing that will hurt U.S. exceptionalism is if we stop allowing great people from around the country who are hungry and looking for opportunity from coming in legally, but coming in good numbers, which has been our magic formula for success for, hundreds of years, and it will continue to be moving forward. But our stocks might underperform for a decade or so. That's okay. They'll still do great. Housing supply, and if you're under the surface in the unmagnificent 493 and small caps, fortunes are going to be made. This is the type of environment where just insane amounts of money are made, just like Cooperman and Buffett and Gabelli did in the 70s once the Nifty 50 started to underperform. Just fortunes were made on a stock-by-stock basis. Billions. That's where they all became billionaires. Housing supply hits 5-year high. That's good. That's going to help with prices. Wait till they continue to open the federal lands. And then all the things are going to happen. The housing supply, QXO, Stanley, Generac, et cetera, et cetera. Front loading is being mainly channeled through air freight. S&P lags international by the most in 32 years. For 6 months, we told you coming into this year that this is not going to last forever. Start getting international, getting emerging markets, in our case, getting China. By the way, update on China for clients. They started the transfer of all U.S. shares to Hong Kong shares. It should be done overnight. So the first step was done where they get the placeholder and then you get converted out. It's 8-to-1 US because the Hong Kong US dollar is pegged at 8-to-1 conversion. So you don't have currency risk. You'll just get 8 more shares for every US share. The price will be the same because the fixed US Hong Kong dollar peg. And so we're doing that to hedge. We think it will be an unnecessary hedge, but we're keeping 100% of our options in the US because there's no way to replicate in Hong Kong. And but our options bucket has always been the huge high expected value and willingness to take our risk is quantified by our sizing. And then the stock, we're not willing to accept that risk. So Navarro and all the hawks can do whatever the hell they want. We are set up because even if the options get impacted, the stock will more than make up for it over time because the fundamentals of the business continue to improve. They continue to generate huge cash flow, 25 billion a year, leader in AI, leader in middle class recovery, leader in everything that we've covered. And one of the lowest multiples relative to growth. It's such an incredible story, and we're so grateful to be a part of it. And we're grateful to Xi Jinping for taking so long to clean things up because it enabled us to have twice the size position that we would have had if he fixed it right away. 37% of U.S. imports from China are intermediate goods used in U.S. production, so that's why both parties need a deal. That's why the Navarro has been hidden under a rock, and Lutnick and Besson has been at the forefront because they figured out that it's not as black and white as it seems, and more rational heads need to come to the table to rebalance, but not to flip everything on its head, which ultimately winds up hurting us. So we're going to get a lot of extraction here. We're going to get a lot of benefits. It's probably net potentially good if it resolves right that we went in this direction. How we did it is up for debate, and I'm the first one to admit that. The fact that we did do it probably needed to be done, and I think it's going to resolve. Like I said, all through the crisis, when everyone's hair was on fire, is welcome to Trump 2.0, same as Trump 1.0, a new tweet, new set of volatility, resolves to the upside over time. Okay, and that's all you need to. If you need anything else, whether you're Democrat or Republican, for the next 3.5 years, just write it down, put it on your computer. Welcome to Trump 2.0, same as Trump 1.0, new tweet, new volatility, resolves to the upside over time. Okay. Here is the estimated global position of systematic macro. These are the CTAs that got smoked, all sold in the hole at the exact wrong time, just like they did during COVID. And then they'll have to chase up on the way up as deals are announced and everyone sees that there was a method to the madness. We're going to be very nice. Trump vows lower tariffs on China. So down from 145 to lower to start negotiations. Then, I don't know. They said they aren't meeting. He says he's not lowering tariffs, but it just keeps getting leaked. So there's probably a reason for that. Structural breakout for the euro. This is something that people didn't expect. The loonies going up as well. These are other themes that we've been consistently pounding the table. Retail net buying of S&P 500 single stocks. Like I said, hedge funds were the morons selling in the hole. Retail were buying. They've been right since COVID. They'll continue to be right. Dollar most overvalued since the Plaza Accord. We've laid out the idea of a Mar-a-Lago Accord, and probably part of a package deal will be an accepted deval of currency in lieu of higher tariffs, just like happened at the Plaza Hotel in 1988. Well, it's the second term. I think it was first quarter of 1988. It's the second term, might have been 86, second term of Reagan. Tesla net income dropping. You got to believe in robots to buy this story. I'll leave it there. We've never owned it. We've never shorted it. We don't have to play. That's the thing that you really have to understand if you want to be a good investor. Just because everyone's talking about something doesn't mean you have to be involved. You want to get involved with great businesses when no one's talking about them, not when everyone's talking. There's still huge risk when everyone's talking. CapEx intentions. You know what I love about Alibaba right now? No one's really talking about it, other than the delisting nonsense, which now we've hedged against that risk. Again, probably unnecessarily, but just need to do it in the case of prudence. That's that. Equity sector flows starting to flow back into technology, starting to flow into, what is that green? Healthcare. That would be good. Roughly 2 in 5 home sellers is starting to give concessions to buyers. Here is from Brendan Ahern. Baba's holdings from Chinese investors via Southbound Stock Connect now 8.54%. So remember, that was a key theme last year. We said get ready after August. Once the Stock Connect opens for Baba, and mainland Chinese investors can buy Alibaba for the first time ever. Imagine being able to buy Amazon for the first time ever. It's going to continue to flow, and that's exactly what's happened. $20-some-odd billion, and probably a lot more to come. Prices bottom before earnings in bear markets. So earnings probably will continue to come down because of all the CapEx that stopped in the last 3 weeks. You could say necessarily or unnecessarily, depending on your views, but bottom line, it froze up a lot of CapEx spending. I hope it's worth it. So expect more bad news about earnings and guidance, and probably the market's bottomed in anticipation of that if we don't retest the lows. But I don't think we're going to go much lower than where we hit in early April, as I said 2 weeks ago. And we went through the analogs of 2018 and 2011, et cetera. Traders plowed $6.6 billion into leveraged long ETFs. Median gross margin is recovered from 2022, a little bit of step back here, but headed back towards record. We'll see if that can be sustained. That's going to depend a lot on tariffs. M&A is slowing. Okay, so this is having knock-on effects that we're going to hear about for the next 3 months. Just like COVID, market bottomed in March 23rd, 2020. Negative headlines until August. The market was already up 50%. Buyback authorizations have increased 19% year to date. Not only are they buying their own shares in this uncertainty, but corporate insiders are buying a lot of stock. Zweig breath thrust, which we recently had, 1 month later, market up 5%. 3 months later, 8.6%. 6 months later, 16%. These are all averages. 1 year later, 23%. So a lot of things have happened in recent weeks that point to very good things happening over the next 6 to 12 months. And based on some of the rational-headed comments coming out of the White House, that looks like a decent probability now. Cash-like ETFs. But look, when the robins are singing, it's already spring, and in many cases you missed it. In this case, there's still enough to do, but really my hat is off for all of the existing clients and new clients that put in new money when I said now's the time, and those who held their wits about them as well. Whether if you weren't in a position to put in new money, maybe you have a lot of illiquid private equity and other things that you couldn't get out of. Kudos for just hanging tough and trusting the process and knowing the intrinsic value of the businesses you own was intact, and now they're rebounding and off to the races. Whether we hit new highs in 4 months or 8 months, it's really immaterial. The key is you held pat when so many others flushed in the hole, particularly hedge funds, to be honest with you. All these cowboys that were on super long, levered long Mag 7, they're smoked, and most of them are liquidating and now out of business. S&P 500 returns a year after spike in policy uncertainty index. With the exception of 2001, which was 9/11, and 2006, which was the housing crisis, the other 8-9 instances have been monstrous, between 9.7% and 63%. That's amazing. Scorecard on buying the dip. Average return for S&P 500 following drop of at least 5% over 2 days. 200 days later, you're up 10%. So again, China firms announced biggest buyback in 14 months. That includes Alibaba. Insider buying and selling. Insiders now starting to buy in a material way. That's very, very key. Number of container ships sailing from China to the U.S., so that's dropped off quite a bit. That's why that should get everyone to the table here to come up with something reasonable, which does, can help China achieve what they want to do, which is more domestic consumption, and help the U.S. what we want to do, slightly more domestic manufacturing. Active listings on the rise for real estate. New home sales top. All estimates on surge in the South. All the federal lands are going to be open. We showed you the map a few weeks ago. Southwest. As a matter of fact, there's a ton of federal land here on the Big Island. And I was telling the helicopter pilot, maybe Trump's going to open it up for development. They didn't want to hear that. It's always NIMBY, not in my backyard. But I can imagine that they would be in high demand if they started to do that. AAII bull bear spread below 20. So this is a record level of bearishness. That's obviously inflection points. Soft data has recently surprised to the downside amid hard data resilience. So people are getting more negative even though the data is showing strength, the actual data. Spending growth has not weakened among the highest income households. Higher income households own around 90% of all corporate equities and mutual funds. That's the top 20%. Income quintile. That's a big quintile, by the way. Total return over 30 years. Gold versus the S&P 500, not even close for everyone chasing gold. S&P is dramatically outperformed. Manufacturing employment as a share of total employment has been declining steadily for 80 years, even after the USMCA. Past 2 weeks have seen historic breadth. This is from Carson. Good things happen 12 months out. All years since 1950, up about double digits. Personnel is policy, so as Bessent has taken the helm, returns have been positive. As Letnick and Navarro had spoken, returns have been negative. Equity leadership cycles and peaks, U.S. versus developed markets, U.S. versus emerging markets. You can see we are at an absolute extreme. And yes, it started dramatic outperformance in the first quarter of this year. This is just the beginning of the beginning. This is like the introduction to the book and then like the prologue. Like we're not even in chapter 1. So if you don't have international exposure, as we've been pounding the table on, and the right international exposure, you're not going to do as well as you've done looking in the rearview mirror through looking through the windshield. Moving forward. White House considers slashing China tariffs to de-escalate trade war. China signals openness to U.S. trade talks, but not under duress. For our country, China's patriots are buying the dip in equities. U.S. chip controls will benefit China's NVIDIA rivals like Huawei, say analysts. Of course they will. China tech groups' unintended consequences of emotional policy making. China tech groups, by the way, DeepSeek and Qwen 2.5, all of these LLMs that are absolutely destroying ChatGPT, and others were made by necessity, not by design per se. The chips that they're developing internally, all this stuff wouldn't have happened. We could have kept them dependent on us. Instead, we forced them to innovate, which is kind of against what they've done historically. They prefer to copy, but now we've forced them to innovate, and now they're a force to be reckoned because they're eating our lunch in AI, and that trend is going to continue. China tech groups lead multi-billion-dollar campaign to help exporters sell at home domestic consumption. Who's the toll taker? 40 cents of every dollar. Ali effin' Baba. Okay, China accelerates budget spending to counter tariff woes. Huge stimulus spending. Baba is going to be the biggest toll taker there. Hong Kong stocks rise on China stimulus hope, ignore Wall Street sell-off. Auto groups lobby Trump administration against parts tariffs in rare unified message. So this is a big deal for Cooper Standard. U.S. officials mull easing tariffs target the auto industry. March sees best new vehicle affordability in 45 months, but tariffs loom large. We know that, except they've got to now replenish the inventory, so the game is on. Trump's U-turns on Powell. China follow dire economic warnings. Trump team needs a trade deal to stop investor panic. That's from Charlie Gasparino over at Fox Business. He's right. I think we probably get one from India, or we probably get one from South Korea, or we probably get one from Japan. But we get one, and then everyone falls in line, and we rock and roll. Vietnam kicks off trade talks with U.S. as plane deal takes shape. They'll get some of Chinese planes. It's hedge funds, not foreign investors, that have been dumping stocks, says J.P. Morgan. Hartnett, amid apocalyptic sentiment, a bullish roadmap emerges. He's one of the best strategists on the street from Bank of America. We cite his Bank of America Fund Manager survey every single month. Deutsche Bank sees major dollar decline amid sell-off. That's typical European pessimists, always downgrade in the hole, even though we remain intermediate term bearish on the dollar based on the type of people getting bearish after the fact. I expect a short-term bounce in the dollar. Boeing to sell some of its navigation business in $10.55 billion deal. So you add the cash at $24 billion plus the undrawn credit line of $10 billion plus the sale now of $10.5 billion, about net 10 after taxes coming to Boeing. You've got $44 billion of liquidity with $53 billion of debt. So the rumors of my demise have been greatly exaggerated for everyone who had been saying Boeing could go bankrupt. You've got brain damage. Boeing's got a $500 billion backlog, and you were the ones that were selling at 130, and now it's at 173, going to 250 and beyond. Boeing to seek FAA approval this year to increase 737 MAX production as losses narrow. They're up to 38 planes a month on the 737 MAX, going to 42, going beyond. They are rocking and rolling. Kelly Ortberg is a winner. He did a 4-bagger in 7 years at Rockwell Collins. He's going to do the same thing at Boeing. Intel plans to slash more than 20% of its workforce. The stock is rising. Trump FDA sends a bullish signal to biotech. New Commissioner Marty Makari's vow to back innovation might ease fears stoked by the Health and Human Services Chief Robert Kennedy Jr. Disney stock is worth buying. Don't sweat the recession risk, analyst says. We agree. Again, these are the people that were selling at $83. Now it's probably, I don't know what it did today, probably mid-90s already. Going to be over 100 again, going to be over 200 in a handful of years or less. Etsy touts shopping domestically as tariffs threaten price increases for imports. This thing's a cash machine. She talks about Depop and the reselling website that's crushing it among the younger kids, the millennials and the Gen Z, etc. Americans are obsessed with protein and is driving nutrition experts nuts. That's a play for Hormel, which we've talked about. U.S. new home sales top all estimates on surge in South. That helps the Stanleys, that helps the Generacs, that helps the QXOs, i.e. Beacon Roofing Supply. And now we've got, hopefully, our Slumer stuff from RBC. There we go. Let's take a look at some of the technicals because we're in crazy times. We have to look at the silly charts. So we probably hit some resistance here coming up next week. It's downtrend line at 48, 54, 84. Now that everyone's happy, we probably go up a little more. Maybe we retest 5100, maybe we don't. But I think the bottom is in, or certainly I wouldn't expect more than a retest, but I don't expect that. I think 5100 test would look good, or we could blast right through on good news, which would really take everyone by surprise, which would also be pretty exciting because we did enough buying in the hole. That's the weekly. Here's the dollar. Probably goes a little lower. Everyone's getting pessimistic. Maybe it finds some support here, bounces back up, and then when everyone gets bullish on the dollar again, that's when we'll resume the downtrend. Gold at a Fibonacci extension level. I could care less about gold. It's a non-productive asset, but you're just betting on some sucker coming in after you and paying a higher price. Usually it's the central banks that buy at the top. I love when people say all the central banks are buying. They're always the last ones to buy right before the top, and then you're going to get some Mar-a-Lago Accord or some deval of the dollar, and that will be it. That'll be the final hurrah, and gold will be dormant for another 5 to 10 years. And you know what? I'm a stock guy. Don't even take that with a grain of salt. I could care less what happens to gold prices. So if it keeps going higher, God bless. Hope you make a ton of money. Keep buying high and hoping to sell it to someone else higher. But not for us. Cleared for takeoff stock market and sentiment results. Here's Boeing. This is all known. We know what was happening. We've just basically covered the liquidity. We've covered the key points. They're turning the corner. Their free cash flow was negative, but it's going to be positive by the second half. It was much less negative than anticipated. That was the biggest news. The production is looking good. The engineering focus is looking good. The backlog increased to over $500 billion this quarter. And up until a few days ago, you couldn't give the stock away. Now people are getting the message, and they'll really be chasing after it hits 200 when no one wanted it when we were on Varney at 130. So it's not that often you get to buy such a clear duopoly at such low prices. I mean, something like that happens a couple times in a career, and it just recently happened. So I hope you all took advantage. That's one of our largest positions, by the way, in the U.S. Maybe I have to check that. It might almost be the size of Cooper Standard, maybe more. I got to check where that is now. Not for long though. Cooper's going to be way more than a double. I can assure you that. That's our view on that. We've covered that many times. So free cash flow usage was good. Commercial backlog grew by more than 25 billion. Okay, let me just get this thing going here. Unfortunately, I don't have my proper mouse with me down in Hawaii. 787 production starting to increase. 737 at 38 going to 42. And then 52 is where it was at peak back in 2018. They'll get back there with approvals over time. Tariff exposure, they basically went through that and talked about the impact. It's not as material as people were afraid of. Net annual impact of tariffs on input costs is less than $500 million annually. That's very, very important. That's kind of de minimis for a company of this size. And the deals are probably going to get better. They got the digital aviation solutions sold to Thoma Bravo. 777X received FAA authorization for additional aerodynamic brakes and engine testing, with daily flights ongoing and performing well. And obviously they got the big F-47 contract worth $50 billion with the U.S. government. And this time it's going to be a profitable contract versus previous fixed price contracts that carried undue risk and turned into money-losing ventures. All 6 KPIs continue to perform well and show stability with every metric currently in the green, including final ticketing, which had been below required thresholds during Q4. You can go through the earnings call. We highlighted the important parts here. And let me just see if there's anything else. Sentiment, as you can see, all the active managers got washed out at the lows, 35% equity exposure. Now this is going to turn around and move back up to 100, and then everyone will want it, and that's when you can lighten up in the short term. REITs, top 30 weights estimates in the last 60 days, down 2.93% for 2025, up for next year. So we're going to start to see a lot of back-end loaded stuff. Utilities, let's see what they did. Down 64 basis points. That's not bad. These estimates will continue to come down on a lagged effect from the tariff stuff, but the bottom may have priced in the worst, and then they'll start to recover over time like we see in every major 20% correction. Economic data, nothing really crazy. Durable goods orders were unbelievable. A lot of pull forward. That cash flow is going to help Cooper. Up 9.2% versus 2.1%. A lot of that's car related. Durables excluding defense up 10.4%. This was a big deal. Initial jobless claims 222,000. That's why you've got Waller and the Cleveland governor out talking about June as a possible cut if we start to lose jobs. Atlanta GDP Fed now has got the administration finally on alert. You're getting your negative first quarter probably of GDP. So get your act together, or you're going to get 2 quarters and the recession is going to cost you more than all the trouble you've caused in terms of Doge and in terms of tariffs. The cost and the amount of spending you'll have to do to get us out of a recession is going to dwarf what you have made in tariffs and what you have made in Doge cuts. So the moral of the story is take yes for an answer, take the win. You've got more tariffs than you've ever had, and you can save a recession if you pivot very quickly and businesses can start to invest again, and it will be a good thing all around, and you will look like a hero. But push it harder and get a recession, and then you got triple loss. And you get wiped out in the midterms, completely handcuffed for the remaining 2 years if you screw this up. So that's that. You can see 2026 estimates going up. 2025 haven't really come down a lot. I mean, the most optimistic was ever 275 sometime late last year. So down to 267, it's not a huge hit. Those will probably keep coming down, and next year will keep going up, which should be able to stabilize the market because the market may be able to look through that. So with that said, let's get down to the Ask Me Anything questions from our incredible audience. And for those of you who don't like the Ask Me Anything questions, thanks for tuning in. We'll see you next week, same time, back in California. For those of you who do love it, let's get started company by company, question by question. Drew Byrne. Drew is a big supporter. Drew Byrne has been with us for many years. Hi, Tom. Hope you and your family had a great time in Hawaii. Still here, man. A few more hours. As Scott's Miracle Grow has been really beaten down. Grateful for your thoughts on it and position sizing. Thanks. I'll never discuss position sizing because that's proprietary for my clients and part of the secret sauce, in addition to the derivative overlay that we do for excess returns without drawing major leverage. But as it relates to SMG, which we do not hold a position, but we do like the idea, maybe more than like the idea here, because we do want to get some ag exposure. The problem here is, what I hate about what they did is they went crazy on the weed trade when all that hype was there, and they got shellacked. They chased a trend versus sticking to their knitting, and it hurt them badly. but probably not badly enough for the stock to be down this much. So I do like it here, Drew. I think you're on your game, and I think your time is pretty good. If you bought a bunch at 53, even if it went down to 40 before it starts to recover, I think you're in good shape. Let me just check out the balance sheet before you go start your research process. All right, let's see here. No, can't make it that small. That should work. All right, so 72 million of cash. $2.5 billion of debt. That could be a problem, my friend. That's going to be the key issue. They're going to have to raise some type of capital. And I don't know if they're going to be able to hit the debt markets with that amount of... So this is the problem you have with this one. This is a really bad balance sheet. You're going to have to figure out how much undrawn credit is and what is the cyclicality of their cash. It seems like maybe their cash peaks in the third quarter based on planting season. That would make sense. But I'm not thrilled with this. So you're going to have to understand how they plan on staying in business. I'm sure they will, but at what cost? Are they going to dilute you with equity? How much debt is coming due? What is their cash flow situation like? Let's take a look at that. Man, how could you screw up a business like this? So they did generate $500 million of free cash flow last year, though. So this is going to be going through all the conference calls. I mean, you really have to be damn certain about solvency risk on this one before you buy a share. And just at first blush, without starting my research process, this one is not making me that comfortable anytime soon. So I got to understand what they're saying about liquidity on the conference calls. I have to look at the cap table, see when maturities come due. I got to see how sustainable this free cash flow was from last year. And if I can get some comfort, then I can start to build a position. But this is not looking good, my friend. So be very cautious as you start your research process. As much as I wanted that to be a win for you, I'm not sure. Alex C. Hey, Tom. It seems like modeling skills are heavily prioritized, but I struggle to see the value in building something like a DCF. What sort of... Of course you have to build a DCF, Alex. Alex, like that's table stakes. That's not going to give you an edge. That's like a starting point. That's bread and butter. It's like learning your alphabet before you read. So yes, you have to do that. And then you have to get a lot deeper into all the public filings, all the earnings call transcript, all the channel checks, all competition checks, Alex, I'm going to suggest what I suggest to every young person. Number one, read The Intelligent Investor by Ben Graham. That'll save you a lot of time. You might just decide after reading that. If you don't get it right away after reading The Intelligent Investor, just go become an entrepreneur and make your fortune that way. There's so many different ways to make money. I find too many people want to get into the investing world because they think that's the surest way to wealth. And if you're coming into this business because you think that's how it's the best way to make money, you're going to fail. If you're coming into the business because it's all you want to do 24 hours a day, then you've got a shot. okay? And this type of stuff is stable stakes. So read The Intelligent Investor. If it clicks, then start reading the CFA books. Do all 3 levels, and that'll give you a basic understanding of the language of the business. And then it just comes from experience over and over. But yeah, you got to learn all the modeling. You got to learn all the basics, and then that's not going to give you an edge. That's just going to invite you to the party, okay? To speak the language. It's like if you go to, the south of France and you get invited to a party and it's all French people. Well, table stakes is you need to learn how to speak French, or you're going to be, SOL. Okay, so then you can speak French. It doesn't mean that people are going to like you. Okay, it just means that you're in the game, okay? And there's a lot more to it. So, Brad K asks, Alcoa, AA. This has always been a really bad business and a poorly run business. So I'm going to just say no, because I've seen so many opportunities to buy it and passed every time, and invariably was proved correct. They do seem to be inflecting here. I just think they seem to again, this just comes from experience. There's something cultural about Alcoa that they continue to seem to snatch defeat from the jaws of victory over and over and over. Maybe this time's different. If there's a new CEO, maybe take another look. But this is a business that I've never owned and never regretted not owning. Let's put it that way. Let's take a look at the balance sheet. I remember they used to have that CEO with the accent who would come on every single quarter and bullshit Wall Street till his eyes were brown. But he had such a sophisticated accent that they believed all his bullshit, and he lost them so much money that eventually they kicked him out, and he had to go build this fake town for Saudi Arabia that doesn't even exist now. He did as good a job with that project as he did with Alcoa. And needless to say, the city does not exist, and I don't think he's running the project anymore. Next week, we'll cover how Tom really feels about a company. Let's just talk here. So revenues seem to be ramping up. Earnings inflecting from being negative. EBITDA starting to recover. It's just so inconsistent. It's so cyclical. You're trying to make the cyclical trade, which I understand that. I'm okay with that, but I don't want to play the timing game with this, because the good times never last with Alcoa. So if you get string a few quarters and the stock doubles, great. Balance sheet looks okay. They'll find a way to screw you. Maybe they'll issue a ton of shares as the stock goes up, but they just have never been a shareholder wins type of company. Where is the shares outstanding? Yeah, so they did it already. They were at 184 million shares. Boom! Like magic, they added 34 million shares in the last 12 months, or between 2023 and 2024. I literally hate management like that. I literally cannot stand management that does. So hard no, right there. Unless they fired the CEO since this offering was done, I want nothing to do with it. Like Brad Jacobs did an offering on QXO, and you could say, well, why don't you hate Brad? Because Brad's got $1 billion of his own money in it before they did the offering, before they found Beacon Roofing. So if he's hurting me, he's hurting himself a lot more. He wouldn't do the offering to hurt himself. He would do it because he saw it was a growth path forward. It was a necessary thing to get it done, to get Beacon done, and he's doing it, and now he's got his platform, and the game is just beginning. Again, this is one you tuck away, and in 5 to 7 years, you have a multi-bagger, whether it's 5x, 8x, 12x, I don't know. I've modeled it to 7 or 8x based on he likes to get 15% of the industry and double-digit EBITDA margins, yada, yada, yada. But it really doesn't matter. You're going to so dramatically outperform anything else you could do that it deserves a position in the portfolio. Nothing is ever a guarantee. That's why it's a position, not your whole mortgage your house, but a serious position, because this guy has made so much incredible amounts of money for shareholders over and over and over throughout his career, and he's got the most skin in the game, personal skin in the game, than he's ever had in any other deal. In QXO, he only put in $150 million. In URI, he put in less. So there you go. Lee Foster, what do you think of Petrobras? We covered this a million times. The financials look fine, but you have a socialist in power, so at any moment in time they could cut the dividend. They haven't done it yet. They may never do it, but it's not a game I want to play. Aaron L., thank you for all you do. I find your weekly video very extremely valuable, especially during those periods of peak uncertainty. The consistency you bring is truly admirable. Thank you, Aaron. That's very kind of you to say. Was hoping you could take a look at Core ATKR. Company offers conduit fittings and various other electrical infrastructure related parts with its manufacturing operations and customer base concentrated in the U.S. Okay, I think we looked at this one a couple weeks ago. ATKR. So prices declined with revenues and cash flow. So what you need to prove out in order to take a stab at this is, what's the turnaround plan? And this is a serious broken momentum stock. And this is where you can get trapped. You have a stock that was a 10-bagger, and then it comes down, 60% in a short period of time. It's probably going to take 2 or 3 years to build a base on this. I'm willing to be wrong on that, but that turnaround plan is probably just beginning. Solution, Polysystems. All right, let's take a look at some financials. So revenues have dropped off from $4 billion down to $3 billion, give or take. Free cash flow is almost halved. Balance sheet, $350 million of cash. $700 million debt, that's probably okay. Share count has come down a lot. All right, so all there is to do here, Aaron, is you got to start your research process. How are they going to turn it around? Does it look credible? What have they said in the past and what's happened? What have they been saying the last 8 quarters as revenues and cash flow have been declining? And if you can get comfortable that their turnaround plan is plausible, and you verify by looking at competitors and seeing what competitors are saying in the space and doing channel checks and doing it, you might have it. But just taking a look at it, I think it's way too early. It's a broken Momo stock. Any thoughts on Flow Traders, Europe's leading market maker? That's a business I tend to avoid. Or Flow, what? FLOW, Flow Traders. Yeah, looks like your cash flow peaked 4 years ago. Never looked back. The stock price is going up without the cash flow. It's a pass for me. Theo Dujardin. Apache, we covered in the past. It's okay. It's not great. The reason they were not as sanguine is we love our Comstock. Yeah, I think we said yes to this a few times. We just prefer Comstock, and we covered all the reasons why. So go back to the last few weeks of podcasts. Buying more VF Corp, you bet. Yeah, all new clients got VF Corp as a full position, so nothing to think about there. That's just tariff noise and BS. You still got the same winner running the show, turning things around, and the tariffs will be what the tariffs are. But their business moats are going to be their business moats, and they've done the destock. They're now going to ramp it up, and Bracken's done this a gazillion times with different brands, going back to his P&G days with Old Spice, then Logitech 26 bagger, and it's going to do the same exact thing. If he's got to sell a couple brands to buy a couple new more, that's what VF Corp has been doing for 125 years, and they're going to do for the next 125 years. So they've cleaned everything up. They took solvency risk off the table with Supreme. Could they sell the PAX business to get a little more cash if they had to? They sure could. But I don't think they'll have to. Moody's reported that March auto sales was 17.5 million on an annualized basis due to pull forward. However, they believe April and May could be ugly. The inventories will still have to be rebuilt. The lobbying is in place, etc. At the end of the day, David, the average car on the road is still 13.5 years. So in the worst case scenario, if the cost of a car goes up $5,000, people are going to buy smaller cars. So it's going to go up $2,500. And then they're going to offer more and more incentives. The affordability is coming down. Why? Because the gig is up. They got away with murder during COVID because they could control supply and demand was high. Demand is even higher now, but they can no longer control supply because the Koreans are going to come in and flood their ass with cheap cars if they don't compete. Okay? And so now they're competing. They're all offering incentives. It's a race to the bottom in terms of margins for the OEMs, which is going to benefit the auto parts suppliers because they get paid on volumes and their prices are pre-negotiated. In the case of Cooper Standard, just finished all their negotiations in the last 6 months. So they're going to mint cash on the race to the bottom with huge volumes. And like Generac generators, the fastest growing states are the ones with the highest penetration. When your neighbor gets a new car, which on average they haven't for 13 and a half years, everyone starts to get new cars, and the game is going to be on, and the incentives are going to be on, and it's going to be a race to protect share by the US OEM. So they're going to have to do more and more dealer incentives, and you're seeing it every single day on commercials, which is going to be a huge benefit for Cooper. So you can listen to the noise in the headlines on a daily basis, or you can step back, zoom out, and actually make intelligent long-term decisions that will make you multi-bags, rinse, repeat, out in 3 to 5 years, on to the next. Auto industry aggressively lobbies. Okay, we got that one already. Peter Retardo asked a question. Literally, this is what they wrote as their name. Really appreciate the great podcast. Extremely generous person. Want to ask the likelihood we get a repeat of the 70s, or did we start our secular bear market in bonds? Being invested in energy is the best way. Thoughts on National Oil Varco? National Oil Varco is kind of a dog, but we've covered it a million times. I think at these levels you're okay. There are better ways to play it. I think if you have to play servicers, you're probably better off going up the food chain to Schlumberger so you can sleep easily at night. But if you want to dig in the dumpster, I would say Varco is probably going to be, probably be a double over a few years. Again, we looked at the financials a few weeks ago. I hate to even take time to do it again. I think it was generally okay. Let me just take a quick look for solvency risk, and then we can move on. Yeah, this one will be okay. Same conclusion we came to 3 or 4 times in the last few podcasts. All right. So here's an Australian that owns US ADRs. Should he exchange? Look, I told you what we're doing. You do it. You're gonna. I don't know how to. You've got to figure out how to hedge out your Hong Kong dollar risk with the Australian dollar. I'm not sure. I don't think you're pegged. I think this is going to be much ado about nothing, but I'm being proactive. I mean, there's no downside other than the commission to just switch them over, which is de minimis. So for us, we did it. As far as you doing it and hedging it out, talk to your financial advisor. You probably do have to hedge out currency in some way, but in your shoes, I'd probably switch it over and just deal with it. Because like, if you look, even if you had a negative currency implication of 20% and the stock doubles, who cares? So, it's better than, Navarro gets in the headlines and then you got to deal with nonsense that ultimately it just destroys the U.S. investors. So, I mean, if they do delisting, it's the dumbest political decision in the history of mankind, because you've basically evaporated $800 billion of your own U.S. investor capital. But stupider things have happened, so you can't completely rule it out, which is why we're just hedging. We're keeping all of our options in the U.S. because we can't replicate them in Hong Kong. So, maybe you do half and half. If half gets wiped, the other half doubles, you're fine. And if nothing happens, everything doubles. That's another way to hedge it. But I would probably take the currency risk in your shoes. That's opinion, not advice. Jimmy Jones, Albemarle. What are the impact of tariffs? No one knows, because no one knows the rules of the game. Okay, so we can wake up. So when you zoom out, here's what you have to think about. What is the demand of lithium moving forward? Is it priced inexpensively or expensively? Do the players that can benefit from the price troughing and rebounding over time, with tariffs or without tariffs, have the liquidity to wait through the cycle? And Albemarle is one of the biggest lithium producers in the world. They've got $3.5 billion of liquidity. So whether there's a 20% or 0% or 50% or 145% tariff, they're still going to have the most share, and demand for lithium is not going to change. So as far as handicapping whether a 20% tariff will hurt earnings by this month or 30 and guessing and pretending you have some edge, there is no edge. The edge is, do you want one of the biggest share companies in the business with ample liquidity to sit through the trough of the cycle and to own it at an enormous discount to intrinsic value, with or without tariffs? And if the answer is yes, I would like one of the biggest players that has ample liquidity to ride it out, because it's a huge hockey stick of operating leverage as prices come back and all the small players get blown out, then Albemarle is for you. And that's why we own it. So good question. And thank you for being a regular listener and contributor. Eric F. He's asking about ones that we've talked about in the past. So we had, we don't spend a lot of time on the winners. We've done Vornado. We've done Range Resources. We've done Rolls-Royce. We've done Wells Fargo. We've done ExxonMobil during COVID. We've done a bunch of them that we've publicly talked about, and a bunch that we've done in private. We did the Google and the Alphabet and Amazon we bought in fall of 2022 when no one wanted it, and we sold them in July of last year. They went up again before crashing in the first quarter, so we looked like we were early. We were right. We did so that's just a sampling. So every 6 months, we probably bring on one or two more new names, and then we close out one or two names and we talk about them, and so on and so forth. So welcome to the podcast. You're obviously new, and glad to have you on board. So with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. Actually, new place, coming back to you from California next week. Have a great one. Bye for now.